Okay guys, hi. So we're going to look at the objectives now, and what I'm going to do is I'm going to do these in a series of 5. I'll do 5 and then take a break. So there's 30 questions, so you'll have 6 short videos, hopefully nothing too long. Okay, great. So it says here, which of the following must be met in order to classify an asset as held for sale? So remember, this is IFRS 5 as held for sale. So what's going on here? We just want to know whether or not we can, first of all, remember we declassify it from being a non-current asset as to a current asset, and it must be, if you like, we must be getting it ready for sale. So first of all, we don't know it'll definitely be sold, and it's a bit unfair to say it'll be marketed the next month. The key point is that it is available for sale, and in intention, because you can see current assets, of course, less than equal to 12 months. So that's kind of our scenario. So we're looking at 1 and 3. Cool. Great stuff. That's that. Now, what's happening here? These people have issued a 3-year 5% convertible bond. So remember that there's no way anyone's going to give you money without wanting something in return. So it says the bond has a nominal value of £250,000. So technically, if we do the double entry, what we're really saying here is we have 250,000 in the bank, and this is bank, and we need to definitely be crediting something. Technically, you would think they would credit loan, but what they're telling us is that actually we don't actually get 250 here. We almost have an equity component to it as well, because when we do the present value of that loan, we don't get 250,000. So why would someone give you 250 and not expect 250 over the life? So we're literally saying, what is that bit, if you like? What is the loan bit? So we need to ask the question. So well, what are you paying over the next 3 years? It tells us, right? So we know that in year 3 you'll be paying 250,000. We know that in year 2 you'll be paying 5% of that. Let me just 1 second. Let me just do the calculation over there. Yeah, so we know that you'll be paying 12,500, and in year 1 you'll be paying 12,500 as well as in year 3. Of course you will. So you pay that. That's what you're going to be paying back. So technically, if we now found the present value of all of these, right? If I found the present value of all of this, I can find out what the present. If I add all these together, that's what this loan is equal to. Right? I'm indifferent between these present values and these payments, and of course I will use the market rate because we're treating it as a loan. This is just the coupon rate. Yeah. So don't be careful. Don't use this one. We're discounting it at the market interest rate. And when we do all of this and we add all these together, we find out that we get a total. When we find the present value here, we have of this first year we have 11,625. So when I say the present value, literally I multiply 12,500 by the 0.93, I multiply 12,500 by 0.87, and I'm multiplying by the 0.82. When I add all that together, I have 11 that, I have 10,875, and I have 215,250, and when I add all these three together, I have a total value of 237,750. So if this is 237,750, it means I must have offered something else as well. It's the equity, and that's the difference. And that comes to 12,250. And that's D. Right. Okay, great. So let's look at this. Which of the following, so this is IAS 8. We're going back, and it's talking about restatement, which requires restatement and retrospect. So we're going back. What do we deal with? And we always go back with errors. Definitely, we always go back with errors. We always go back with policy. We do not go back with estimates. We just don't go back with estimates. And so estimates are just perspective, if you like, perspective. But the other two, we always go back. Of course, usually there's a sort of loophole to that. When I say loophole, I mean if it's possible, in terms of especially material error, if it's not going to be too complicated, and if it's material enough, if you like. You see it says material, right? Okay, great. So the answer is B there. Again, like I said, I'm going to do 5 and stop, sort of do them in 5s. What's going on here? So we are told that these people purchased an investment property here. So here's the thing with investment properties that you should know straight away. We value investment properties at their current value. We do not depreciate investment properties. We just do not depreciate investment properties. And we just, all movements go straight away to the statement of profit or loss, straight away. Right? That's what we do. We buy and sell properties, we rent them. Right. So what do we have now? So if we look at this here, it says that it's currently valued at this, and the property has this. The valuation has just been received, and these are the estimates for the next. So it's fallen in value. So it was 3,005. So basically we have property 3.5, and now the carry down figure is 3.25. So it's fallen by 0.25. So you can see straight away that we have a loss of 250,000 in the statement of profit or loss. Everything goes straight away. Right, what do we have here? So it says that these people purchased an asset, and they received, so it says they purchased an asset on the 1st of July. I mean, I'm always going to use double entry. It just works. So here we are. You purchased an asset for 250,000. And, well, however you've purchased it, let's just say in the bank, that's fine. So you've paid 250 out of the bank. But you receive a grant. So you receive a grant. So you have bank, 30 grand. And you have some kind of deferred income or deferred credit of 30 grand. And it says you wish to treat this government as a deferred credit. The useful life is 12 years. So you're literally saying that I will shift this 30 grand into or against. So I'm literally going to go X. This is the asset. I'm going to use, use this against any depreciation, if you like. So take it out of this and release it into the income statement, if you like every single year. So it says you bought it on the 1st of July. So 1st of July to the 30th of June 2003 is 1 year. So if you divide 30,000 divided by 12, that gives you 2,500, doesn't it? So that's 2,500 every year. So the first year, 2,500. So 2,500 comes out of here and goes into income, 2,500. And then you have another year to the 30th of June, which finally leaves you with a carry down figure of 25,000. Right, doesn't it? Because you've taken 2 years out of the 12 into the income statement. Cool. Great stuff. Yeah, and let's stop here and we'll do the next video with the next 5 questions.